Welcome everybody. We're here to follow two presentations about arbitrage profits in decentralized exchanges. So I'm Paolo Guasoni from Dublin City University, and I will moderate these two presentations. Our first presentation is going to be from Ciamac Moallemi from Columbia University. He's the William von Muffling Professor of Business. And he's going to tell us about his work on lever, which I'm sure many of the attendees will be familiar with. And the second presentation will be given by Alex Nezlobin from GuideStar, and he will tell us more about his company later. And Alex also has a paper on lever, which connects with what Ciamac has found. And we look forward to see the analogies and differences and the relationship between their work so that we can better understand what's going on in these arbitrage profits and more generally informational trades in decentralized exchanges. So having said that, I think it's time for Ciamac to start and for me to be silent.
Great. Excited to be here today. Thank you, Paolo, for the kind introduction, and thank you also to Fahad for the invitation to speak today. So as Paolo mentioned, I'm a professor at Columbia University, but it is also worth mentioning that I'm a research advisor for Paradigm, which is a large venture capital firm in the blockchain space, and for Uniswap Labs, which is the developer of the Uniswap protocol. And so I may have some financial interests in some of the things I talk about. So that's just in interest of full disclosure. But what I'm going to speak about today is the economics of liquidity provision in AMMs. And this is a question that I've sort of been thinking about in various ways over the past a few years. The kind of core questions are, how do we measure the performance of liquidity providers in AMMs or constant function market makers? In industry, it sort of started out with this idea of looking at fee yield, and then went to this idea of maybe something called impermanent loss, and so on and so forth. But my agenda has been sort of trying to think about how to make these ideas rigorous, to understand whether these mechanisms are a good idea, and whether in particular being a liquidity provider is a good idea. And downstream of that, understand how the answer to that question depends on things like, what kind of asset is being traded, and maybe how volatile it is. What are characteristics of the AMM, maybe even characteristics of the blockchain, and hopefully lead to ultimately improving AMM design. So what I'm going to talk to you about today is two papers. The first paper introduces this idea of loss versus rebalancing, which is sort of, I'm going to argue, is a core economic idea in terms of understanding the performance of AMMs. And the second paper sort of refines the model of the first paper in order to really account for the presence of fees. So what I'm going to tell you about today are these two papers, and just in a little bit more detail. The idea of loss versus rebalancing is if you start out and just look at how much money an LP has made or lost, that's a question we can ask with accounting, right? We can just look at, how many tokens did you put in at the beginning, and what were they worth, and how much could you take out the end, and what are they worth then? And we don't need a model to answer that. But the problem with that kind of gross P&L calculation is that it's really dominated by the market risk of the tokens. Right. So as I'm sure this audience knows, in an AMM, you hold reserves of the tokens, and typically at least one of those tokens is a risky asset. So if you look at your P&L, it's basically dominated by whether the price of that risky asset went up or went down. Simply, did the price go up or go down? That's it. That's really the first order thing. But in some sense, that's not interesting, right? Because if we want to bet on the price of the asset, there are mechanisms to do that. Just go long, right? Or go short or whatever, right? What we're really interested in is what's special about being in the AMM. And that's the idea of loss versus rebalancing. The core of loss versus rebalancing is if you apply sort of the seminal idea of Black-Scholes-Merton, if you dynamically hedge, if you take away that market risk, right? In other words, if you short, have a short position equal to the other reserves you hold, then what's left, which I'm calling the delta hedged P&L, that's simply a difference of two terms. The first term is the fee income that you earn. And the second term, which is really sort of the main contribution, is the loss versus rebalancing, which is basically adverse selection, right? And so the idea here is in an automated market maker, you have a mechanism that is setting prices on chain that is unaware of what the value of the asset is in the real world. And from time to time, its asset values are stale, right? It has a price that is maybe too low or too high versus what is sort of the fair value of the asset at that time. And it's going to be picked off or exploited by arbitrageurs who are going to buy from it when its price is too low or sell to it from when its price is too high, and they're going to make money. And that money is going to come from the pockets of the automated market maker. And what we do is we quantify this adverse selection cost, which we're calling loss versus rebalancing or lever, and we give a formula for it. So I don't have the tools to explain this formula now. I'll explain it a little bit later. But what I'll point out is that it works pretty well empirically. Right. So that's our core starting point. However, this model is made under some assumptions. And in particular, it assumes that number one, the arbitrageurs, when they're trading on the pool, they do not pay fees. Right. But of course, everyone trading against the pool, including arbitrageurs, pays fees. So that's an assumption that's not true. And there's a very related assumption, which it assumes that these arbitrageurs monitor the pool in continuous time and continuously trade in any instant in time when the pool price deviates from the fair value. And that's not also true. And it's not true because of the fact that these automated market makers are implemented on blockchains, which are fundamentally discrete time systems. Right? The Ethereum blockchain generates a block every 12 seconds. That means you can only trade every 12 seconds. You can monitor, what's going on in the outside world, maybe in between or whatever. But when it comes time to an arbitrager to trade, they have to wait till the next block is generated, right? So what we're going to do subsequently is we're going to relax these two assumptions. And we're going to try and understand what is the impact of both, number one, fees and discrete blocks. And what we find is that under the assumption of Poisson block generation, that the amount of money the arbitrageurs make is kind of like what we had before, the loss versus rebalancing, but is also scaled down by this quantity over here, which I'm calling P trade, which is the probability of trade. And the idea, which I will explain in what follows in this talk, is when there are fees, there's a chance that the arbitrageur arrives at an instance, or more precisely, I should say, a block is generated at an instant in time when the deviation between the price of the AMM and the fair value is less than the fee that needs to be paid to the AMM. And in those instances, the arbitrager won't trade, right? So here it's scaled down by the probability that the arbitrager is actually able to trade or P-trade the probability of trade. And if we look at the parameter dependence in terms of things like the volatility, the block time, and the fee, we see that as we make the chain go very fast in the fast block regime, the arbitrage profits scale according to the square root of the block time and go down to zero. Right. Now, this result here, it turns out this has important practical implications. This is the main driver for wanting faster blockchains. Right. In other words, we're in a world where we have things like Ethereum with a 12-second block time, maybe something like Solana with a 400, 200 millisecond block time, something like that. L2s with similar block times, Hyperliquid with a 70 millisecond block time. Part of the driver of wanting faster and faster blockchains is, on the one hand, it has a better user experience, right? Users always want to trade more quickly. But what we say here in this paper is that there's another purely financial driver in that having a blockchain that is slow is going to create frictions that are going to cost money to liquidity providers and dexes on this blockchain. And so this is a direct financial motivation to want a faster blockchains. And our model sort of crisply characterizes how this is. The intuition, which I'll speak to later in this talk, is that faster blocks basically create more intense competition between arbitrageurs. And as we go to the continuous time limit, as delta t goes to zero, eventually the arbitrageurs compete away all of their possible profits, and the liquidity providers lose nothing. Right. So that's the core result I'm going to speak to. I'll speak briefly about how the results here and our techniques also extend to more complicated fee structures, like thinking about what if the arbitrageurs also have to pay for gas. And I'll also point out that our results are consistent with subsequent empirical work by others. So that's what I'm going to talk about today. There's a whole bunch of literature in this area. I've thrown a bunch of it up. Probably what's most directly related is the work of Alex Nezlobin and Martin Passy. And unfortunately, Alex is going to speak directly after me about that. But I will spend a little bit of time in my talk also contrasting some of our assumptions with some of his assumptions. So with that, I'm going to launch into it and start to speak about the model. Okay, so here's a setup. The TLDR is that we're going to start out working in continuous time in something very reminiscent of the Black-Scholes model of options pricing. Without loss of generality, I'm going to imagine there's two assets, a risky asset X, which I'll denote by X, and a numeraire or cash asset, which I'll denote by Y. So you can imagine maybe I'm trading the ETH token versus USD or some USD token. This is without loss of generality in the sense that what I'm telling you can be extended to the case where there's more than two assets, or to the case also where maybe you have two risky assets and neither one of them is the numeraire and so on. But we'll stick with this more basic framework. Also, without loss of generality, I'm going to assume that there's no interest, right? And again, that'll just simply save me from having to write R in a bunch of different formulas. It's pretty easy to introduce interest or a cost of a capital. So these are kind of two assumptions I'm going to make. And my starting point is that, again, the spirit here is to leverage the idea of the Black-Scholes model. The Black-Scholes model is a derivatives pricing model. It tells you how to price a derivative given dynamics for the underlying. So here what we want to do is we want to quote unquote price being an LP and an AMM given the dynamics of the underlying token. And so that's going to be given by a process called PT. Right, so PT is going to be a stochastic process in continuous time. We can think of it either as like a reference price or market price of the risky asset, or for example, you can think of it as the price on a deep liquidity centralized exchange, maybe a place like Binance, right? And the idea here is that centralized exchange is where price discovery is going to occur. Right, so we're going to track the price on the centralized exchange, and moreover, I'm going to give it dynamics. I'm going to give it dynamics according to the equation at the bottom, the stochastic differential equation. And the idea here is this is more or less a geometric Brownian motion, right? This is a sort of standard assumption in a continuous time finance. More specifically, I'm saying the instantaneous returns, in other words, the returns over very short horizons, are going to be normally distributed with a particular mean and a particular variance or volatility or kind of a standard deviation. That's all this fancy notation means. One sort of wrinkle is it's convenient to allow this volatility to be time varying, so I will kind of allow that. But the idea is that this is sort of the underlying asset. Again, we can imagine these are dynamics on an infinitely deep centralized exchange. Right. So let me talk about how the AMM works. For this audience, I think this should be a relatively rote. So I'll try to go through it a little bit quickly, but it's nevertheless useful to establish a common notation and so on. So the idea of an automated market maker, sometimes called a constant function market maker, is that you're given a bonding function f, And that bonding function is going to be an invariant on the quantity of reserves of the risky asset given by X, reserves of the cash asset or numeraire given by Y. We're going to have an invariant of these two. Right, so a typical bonding function would be something like a product or a geometric mean, the so-called constant product market maker. That's what I plotted here. Here I'm requiring the product or the geometric mean of the two assets to be the same. And the idea of a constant function market maker is that initially the LPs, the liquidity providers, they will contribute reserves to the pool such that you're somewhere on this curve. And over time, traders can come in and trade against the pool, and they can move it from the point it was at where they arrive, in this case, the purple point, to any other point on the curve. In other words, for example, this green point, right? So this is called a constant function market maker because it allows trades that maintain the invariant that this function stays constant. And if you think about this for a second, this is sort of giving you a menu for how much it would cost to trade any quantity. In particular, for example, if I'm a trader and I arrive and I want to move from the purple point to the green point, what I have to do is I have to contribute the X asset to the pool. I'm going to move to the right on the horizontal axis. So I need to contribute the X axis, but on the vertical axis, on the Y axis, I can withdraw the Y axis. Right, so moving from here to here, I'm selling the risky asset to the pool in for units of the of cash, right? And what is the price I'm getting? The price I'm getting is simply the ratio of those two segments, which is the slope of the hypotenuse of that triangle. Right? So that's a basic description of a constant function market maker. It's going to be useful to have the notion of a spot price. And the idea of a spot price is if we shrink the quantity of trade to an infinitesimal quantity, then that triangle will shrink to sort of a tangent line, and that gives me the spot price. So if the reserves are given by this red point, the spot price is simply the negative of the slope of the invariant of the tangent line to the invariant at that point, and that's going to be a very a useful construction for us. Right. So that's the basics of trading. There's a couple of wrinkles to add on. One is that there are fees. Haven't talked about the fees so far, but the fees are typically collected in proportion to the traded quantity. And so this is akin to sort of spread capture in traditional markets, i.e. we can imagine the spot price is something akin to something like a mid price in a traditional market, right? And of course, a market maker will not sell you something at the mid price. They either sell you at the bid or the ask. So there's, either pay up a half spread or down a half spread. Here, there's not really a notion of a spread per se. Instead, we have something like a fee, right? But basically, you can consider the fee as like a half bid-ask spread on an infinitesimal trade. So for example, the Uniswap V2 protocol demands a 30 basis point fee on the contributed asset. So fees are going to be something that's important. And maybe one other ingredient is that these liquidity providers, over time, they can arrive or depart. As they arrive or depart, they can contribute or withdraw assets from the reserves in a proportionate way. And that kind of amounts to moving between different level sets of the bonding function, right? So for the purposes of this talk, I'm going to imagine that the liquidity providers are largely passive, or entirely passive, in fact. So they're simply going to maintain the original invariant, but this is just how things work more generally. Okay, so that's a constant function a market maker. A key kind of ingredient in order to sort of think about these and analyze them is the idea of the pool value function. Let me walk through the idea of the pool value function. The pool value function is the value of an optimization problem, and the idea is this. The idea is, suppose I tell you that the price of the X asset in terms of the Y asset is given equal to P. What you do in the pool value function is you find the configuration of reserves for the pool that satisfy the invariant, in other words, that are allowed configurations, such that the value of the pool given price P is minimized. Right? Now, why do we want this minimized, and what is the importance of this pool value function? Well, the idea is that this pool value function captures what arbitrageurs are going to do. right? What are arbitrageurs are going to do? If an arbitrageur comes and arrives and values the risky asset at price P and observes what's going on in this pool, the arbitrageur will trade against the pool to make as much money as possible, right? And when the arbitrageur trades against the pool in order to make as much money for themselves, that is zero sum between the arbitrageur and the LPs of the pool. So the arbitrageur maximizing their profit is equivalent to the pool value being minimized. Right. So that's why this is a minimization here. It's a minimization because this is an adversarial environment. You have these agents who are constantly arriving and they're trying to, make money. And that means, minimizing the value of the pool. And it also encodes kind of what's going on through arbitrage, right? If we can imagine in advance that there are arbitrageurs out there, we can kind of predict that, well, whenever the price is P, they're going to drive down the value of this pool, factoring that in, and therefore the value of the reserves are going to be given by V of P, which is the value of the minimum, the smallest value of configuration of reserves that's possible under the invariant that should still be satisfied. So that's the idea of the pool value function. I'm going to make an assumption that an optimal solution here exists and is unique, and that there's sufficiently smooth and so on. And again, most AMMs, in fact, all AMMs I'm aware of largely satisfy this. So just to give you a little bit of an example, if we have a constant product AMM like Uniswap V2, we have this optimization problem, but we simply plug in the invariant. It's a quick exercise in sort of undergraduate calculus to sort of write out the Lagrangian and solve this optimization problem. And you see that the optimal position in the X reserves is given by L over root P, Y is given by L root P. And what's actually true in this case is the value of these two is equal. In other words, if I have X star of this quantity of X star and it's worth P, and this quantity of Y star and it's worth 1 because this is the cash asset, then the value of the pool is equal to twice either of those, right? And so that's just a simple example of this. One thing you may observe is that this X star of P is a decreasing function. As the price goes up, the pool holds less and less of the risky asset. And that makes sense. As the price goes up, the risky asset is going to be more valuable, and ARBs will extract it from the pool. And this kind of motivates thinking of that function X star as kind of like the LP's passive demand curve for the risky asset. Right. So I plotted the curve over here. And again, the idea here is if you're a liquidity provider and you're deciding to participate in this pool, again, you can imagine ex ante. You know that there's arbitrageurs out there. You know that they're going to trade against the pool. You know that as the price goes up, they're going to buy tokens. And in fact, you know exactly what rate they're going to buy tokens from the pool because you solved the pool value function problem, right? So by participating implicitly, you're kind of like saying, hey, I'm participating in this mechanism. I'm agreeing that I'm going to hold less risky tokens as the price goes up. And so in other words, implicitly, at least, that is the demand curve for the liquidity providers. Right. So I think that these demand curves are really a nice and fundamental way to sort of think about things. Okay, so let's I'll go to the two types of traders. Already talked about the arbitrageurs, but just to sort of reiterate, I'm imagining they continuously monitor the market. They can trade in the mechanism, or they also have access to this infinitely deep centralized exchange. And so the second that the prices of the mechanism of the automated market maker differ from the centralized exchange, they will trade until those two are equated. And equivalently, they will trade until they minimize the value of the tokens in the pool. And up to now, I've assumed that the ARBs do not pay fees. This, of course, we will revisit. That will be the content of the second half of the talk. Right. On the other hand, we may have other agents. I'm going to call these noise traders. I'm going to assume that these agents only trade on the constant function market maker. I'm going to assume they trade for their own reasons, for quote unquote idiosyncratic reasons. And in particular, what I mean by that is they are not trading for informational reasons. They have no information about what the fair value of the asset is now or in the near future or whatever. Again, they're trading for their own idiosyncratic reasons. it's convenient for them to trade on chain, or maybe they're hedging something, or who knows what, right? But I'm not modeling them, but they do take trade fees. Right, so I'm largely not going to model these noise traders, but I am going to I'll look at the fee income that's collected from them. And so if I think about what are the streams of P&L in the pool, well, there's two streams of P&L. The first is if you're a liquidity provider, the first thing you did is you deposited some tokens in the pool. And so there's the value of your pool reserves. That's the first term here. That value may change from time zero to time t. So that's one component of your P&L. And we know how to sort of understand this because we know at any time t, I just argued that the value of the pool has to be given by the pool value function evaluated at the then current price p of t. And that's because of the presence of these arbitrageurs. And then there's a second term, which is the cumulative fees that are collected up to time t. Right. So what we're going to do now is we're going to double click into the first term, how the pool reserves change. And here it's helpful to introduce this idea of something called a rebalancing strategy. And it's going to help us decompose this pool value change. And the idea of the rebalancing strategy is let's do the same trades as the AMM, except instead of doing it on the AMM where an ARB trades against the AMM, let's just imagine we had access to the centralized exchange and we're going to do those same trades, but we're going to do them at centralized exchange prices, right? And so more formally, we can define this as a self-financing trading strategy. In other words, after time zero, we're not going to put in or take out money. Initially, we're going to match the holdings in the pool. At any later time, I'm going to trade the risky asset in order to have the same risky asset position as what the pool has, right? And then if I have a portfolio that's self financing, its P&L can, and I have no interest also, its P&L can only come from changes in the asset value, right? So the value of this portfolio is its initial value. Plus, in each period, you hold some amount of the risky asset, and over that period, the price changes. And here I'm sort of writing it out in discrete time, but if we shrink the delta t to zero and we go to continuous time, we get that the profit and loss after time zero is given by this Ito integral below. Right. So this is the rebalancing strategy, and the main result here is to decompose the LP P&L. As before, we have the fees, but in terms of what's left after the fees, we have two components. We have the P&L of this rebalancing strategy. However, relative to the rebalancing strategy, you do worse, and the amount you do worse by is a quantity called lever or loss versus rebalancing. Again, how much worse than the rebalancing strategy that you do. And we can say some things about this process, right? In particular, this process, it's truly a loss process. You're always, it's non-negative. It's increasing over time. So when you lose money, you never get it back. You always lose more money. And it's predictable in the sense of over short time horizons, you can predict it. And also we have a formula for it. And I'm going to parse this formula for you in a second. So I'll pause here. One note I do want to say is if you've heard of the concept of impermanent loss, this is not impermanent loss. It's different. One way the way I like to think about it is that this is impermanent loss done correctly, right? So if you think impermanent loss is the right idea, I disagree with you, and I'm happy to sort of debate that. But maybe sort of phrased a little bit more subtly, impermanent loss is really a one-period concept. Lever is kind of the right sort of continuous time concept. Impermanent loss, for those who know it, measures versus a static benchmark, right? Levers kind of recognizes that the benchmark needs to change over time and eliminates some of the issues with impermanent loss, which again I don't really would prefer not to get into. Right. Let me explain a little bit where this the formula came from. The formula comes from the fact that why do we do worse than the rebalancing portfolio? Well, the rebalancing portfolio is what we'd get if we traded on the exchange. Who is doing similar trades on the exchange? The ARBs, right? And so kind of the difference between our P&L and the rebalancing portfolio is really money that's being made by the ARBs, where they're trading at favorable prices for them on the AMM versus the fair value on the centralized exchange. And favorableness for the ARBs translates to a negative cost, this lever for the liquidity providers. And in particular, I'm not going to go through this in a super amount of detail. The intuition for this formula comes from the fact that if over a short interval of time, the price changes by a quantity dp, well, the arbitrager is going to trade some quantity dx to exploit that. If you kind of go through the math, how much money the arbitrager makes is they make the quantity trade by about half the price change, because they're going to push from the old price to the new price, and they're going to get the average price on the AMM in between, versus the external price is just the final price. And so if you ask how much did they have to trade, well, over a very short interval of time, how much did they trade? Well, they're moving the price from P to P minus DP. We already know how much they trade. How much they trade is given by the demand curve. We know if that I'm at a price P and I move it a little bit, the derivative of this demand curve is going to tell me how much they're going to trade, because the derivative of this demand curve, the slope, that's kind of like how much liquidity is sort of instantaneously or kind of marginally at that price. Right? So how much do they trade? They trade in proportion to the derivative of this times the price change. So once you sort of plug that in, you get the formula that how much the pool is going to lose is, again, the derivative of that demand curve, what I call the marginal utility. Again, how much a liquidity is, at that exact price, times the square of the price change, and that's what's called the quadratic variation in continuous time stochastic processes. So that gives us this formula. This is at one instant in time, and overall the loss comes from integrating this. At every instant in time, basically you lose in proportion to how much liquidity is instantaneous at that price, times the local quadratic variation. What is the square change of prices sort of instantaneously here? And over time, we're simply going to integrate that. Okay, so going back and again, I had a decomposition for the change in pool value. If I go back to the LP P&L and plug in the result I had, instead of the change in pool value, I have the rebalancing P&L minus lever. What I'll observe here is this rebalancing P&L. This corresponds to a trading strategy. It kind of corresponds to sort of a little bit the mirror of what the arbitrageur is doing. Right? And so in theory, what we could do is we could hedge it. Right? So if we hedge it, for example, taking a short position and a centralized exchange or whatever, corresponding to at any time what the reserves are in the asset, right? Then this will be this term will be eliminated, and our hedged P&L will be left with simply the fee income minus the loss versus rebalancing. Right. So this is the way the lens we're going to view the profitability of the arbitrageur. And again, this highlights what's special about investing in an AMM. What's special is not this rebalancing P&L, because potentially you could have done that, trading the risky asset otherwise. Right. But instead of earning this rebalancing P&L by being in the AMM, you're going to get these fees, but you're going to do a little bit worse than the rebalancing portfolio, because the ARBs are going to take money from you, and so what's left is fees minus level. Okay. On the other hand, what if the ARBs pay fees? I assume that the ARBs do not pay fees. Right? In reality, AMMs have trading fees, which every trader pays. Right? So this is a primary issue. It's going to turn out that closely related to that is a secondary issue, which is I also assume the ARBs are continuously monitoring the market and trade continuously. And again, that's also not true. AMMs are typically implemented on blockchains, and you can only change the state of a blockchain. In other words, you can only trade at instances of a block generation. So these are fundamentally discrete instances of time. Right? So what we're going to do is we're going to relax these two assumptions simultaneously. Right? And so let me walk you through that. Let's start out with the picture we had before. So here I have a time axis, and on horizontally and vertically, I'm looking at the market price of the risky asset, what I call P of T. I can superimpose the market price of the AMM, and that's going to be the blue curve. And you'll see they're right on top of each other because here I'm imagining I have an ARB, or sorry, I have a universe of ARBs which are continuously monitoring and continuously forcing them to be the same. So what's the first thing I'm going to do? The first thing I'm going to do is I'm going to say, suppose that they cannot trade continuously. They can only trade at instances where blocks are generated. Well, what will happen is the blue curve, instead of tracking the red curve exactly, what it's going to do is it's going to look like this. It's going to be a jump process. The X's on the time axis are instances at which blocks are generated. And at an instance where a block is generated, wherever the blue curve was before, it's going to instantly snap to where the red curve is, right? So introducing discrete block generation, I transform the blue curve from being, something that's exactly on top of the red curve, the price curve, to something that is like a jump process that jumps to where the red curve is at instances of block generation, right? Now I'm going to make the second move, which is now I'm going to add fees. And so what I'm doing here, this band I'm drawing around the blue price is a band corresponding to the fee. So again, the blue price is the AMM pool price. What I mean by that is the spot price, right? Because of the fee, if you want to buy from the AMM, you have to buy at this dashed line, the higher price. If you want to sell to the AMM, you have to sell at the lower dashed line. That's the bid price. So we kind of have an ask and a bid. So now when blocks are generated, there might be instances where blocks are generated, like for example, this first red X. Here, if you sort of zoom in there, the AMM price, the spot price and the pool price do not match. However, their difference is quite small and is smaller than the fee. So there's no arbitrage trade there. Similarly here, a block is generated, but the difference is small, no arbitrage trade, and so on, right? On the other hand, at the green instances, this is another instance where a block was generated. Here, the red curve was outside that dashed gray no trade region, right? So here, the arbitrager trades. And how do they trade? Well, they trade so that the marginal price they pay, which is the spot price plus the fee, equals the external value of the asset. In other words, they trade until their marginal profit is zero. And so in other words, they're going to move the blue line up so that the dashed line matches the external price. And that's the same thing that's going on at the second block generation point over here. Here, the outside price was the external price was less than the pool price, so the arbitrageurs will move the pool price down so that the pool price, including the fee, equals the outside price. Right. So that's the impact of arbitrageurs and discrete block generation. So in the two green instances, there's a trade. In the two red instances, there is not. And so we have to make some additional assumptions. So we see that block arrivals really matter. So I'm going to assume now that block arrivals are Poisson, and delta t is going to be the mean inner arrival time. This is a good model for proof of work chains, but it's actually not a really good model for proof of stake chains. Basically, every proof of stake chain that I'm aware of, and almost all the chains, or all the chains essentially, that AMMs are implemented on are actually deterministic. However, we're going to do that for tractability. And fortunately today, Alex is going to tell us a little bit later what if anything is going to change because of this. But for tractability, I'm going to assume that the blocks are generated at Poisson instances. I'm going to assume that there is a proportional fee, for example, maybe a 30 basis points that everyone, including the arbitrager, pays. As before, P of t is going to be the external market price. Before, I didn't really have to track what was going on at the AMM because the ARBs were always enforcing that the AMM was consistent with the external market price. Now I see there can be deviations between what's going on in the AMM and the external market. So I'm going to have a process P tilde, and that's going to be the blue curve I showed you before. At any point in time, that's going to be the implied AMM spot price, right? So this is going to be kind of a state variable, which is going to describe to me what are the current reserves of the AMM. And I have to keep track of this because the frictions I introduced mean that at any given time, the AMM is not going to be 100% consistent with the outside external sex price. And so one way that's going to be convenient to think about this is going to be think about the difference between these two, in other words, the mispricing. And in particular, we're going to look at the log mispricing between the spot price on the pool and the external market, and that's going to be a new state variable for us. thinking in the language of this state variable, before I had this picture of what was going on with the external price, that's the red curve, and the blue curve is the AMM spot price. If I look at the difference between them, I'm going to get this curve. I see that in general, it's kind of a diffusion. It moves around, and it's going to inherit that from the external price, right? But at instances of block generation, depending on whether it exceeds, mispricing exceeds the fee or not, when it exceeds the fee, the arbitrageurs correct it until the mispricing equals the fee. In other words, they push it back down to this boundary either way. And if it doesn't exceed the fee, the arbitrageurs don't trade, right? So that gives the dynamics of this mispricing process. And so again, to kind of summarize, arbitrageurs trade only at block generation times. I'm imagining perfect competition between the arbitrageurs. So when there's perfect competition, the arbitrageurs are going to trade myopically until there's a no marginal profit. So in other words, they're going to trade so that they push the mispricing either to the level of fees if it was outside the fee boundary, but if it was inside the fee boundary, they don't trade. Otherwise, the price simply diffuses according to the geometric Brownian motion dynamics of the external price. So in other words, this Z of t, this mispricing process, it's a Markovian jump diffusion process. I'm going to make one more assumption to sort of get rid of this drift for convenience. I'm going to assume that mu is equal to half sigma squared. This is relaxed in the paper. It just makes the formulas a lot simpler to do this case. What's special about this case is, aside from these jumps, the mispricing or the external price is a martingale, and that just makes the formulas much easier. Okay, so a kind of side note, this goes back to why we needed to have discrete block generation. If we imagine the model I showed you, but with continuous trading, i.e. delta t equals 0, I would still have a mispricing process, but it'd be a reflected Brownian motion. Anytime I even like touch the boundary, I instantly get pushed back by an arbitrageur, right? And if you know anything about reflected Brownian motions, what's true is actually they spend 0 time at the boundaries, right? Because they immediately get pushed away. And if they spend 0 time at the boundaries, it means that with probability 1, if you sort of wake up and look at the system, they're in the no trade region. And what that means is that arbitrageurs don't make money. And that's just obviously wrong, right? I've met arbitrageurs. They make a lot of money. They eat very well. And so the issue is with the model. And the thing that's wrong with the model is that if you want to account for the impact of fees, it's actually fundamental to account for the fact that our arbitrageurs can only trade when blocks are generated. And this discreteness is actually sort of critically important. Okay, so under my assumptions, what we're able to do is we have this Markovian jump diffusion process for mispricing. We're able to compute its stationary density. It looks something like this. Again, the no trade region is when the mispricing is less than the fee. If it's bigger than the fee, you can either sell to the pool and make money or buy from the pool and make money, and it's exponential in those regions. And one sort of critical property of this is the probability that you're actually outside the no trade region, and that's given by this expression over here, right? So this expression is a probability in steady state that you wake up and like you sort of look at the blockchain, an instance of block generation, and the arbitrager is able to properly trade. So just to sort of give you like kind of what these sort of numbers would look like properly calibrated, if I imagine like sort of 5% daily volatility, which is kind of a typical number for ETH USDC or whatever. Here I have a table. I can imagine maybe 12-second block times like for Ethereum, and maybe if I had like a 5 basis point pool, I would imagine in about 45% of Ethereum blocks there should be an arb trade. If I go to a 30 basis point pool, maybe only 12%. In a 100 basis point pool, maybe 4%. Right. So, again, I don't know what the numbers exactly are, but these aren't crazy, right? If you look at, the presence of arbitrage trades in pool, there's, definitely significant percentages, right? So this is one ingredient, but this is not the thing we're interested in. The ultimate thing we're interested in is the arbitrage profits. And the way I'm going to think about this is I'm going to define arb t to be the cumulative arbitrage profits over some time interval 0 to t. And the thing I'm going to look at is the expected instantaneous intensity of arbitrage profits per unit time. In other words, I'm going to look at the expected value of the arb profits over the time interval divided by the time interval when I shrink that time interval to zero. Right? So that's one thing I'm going to look at. Later, I'm also going to be interested in the quantity of fees that the arbitrageurs pay. So I'm also going to have a similar intensity per unit time for the fees. And if you sort of, sort of think about this a little bit, when do arbitrageurs make money? Well, they make money sort of the fraction of the time that they arrive and are able to trade times the conditional profit conditioned on being able to trade, being outside the no trade region. And if you do that calculation, you can quantify the arbitrage profit. So in the paper, we have some results that are exact. For example, for a constant product market maker, I'm going to show you here asymptotic results that apply for any pool. They're asymptotic in that I'm interested in the fast block regime. I'm interested in the regime as the block time changes going to zero. There's a bunch of kind of symbols over here, but I'll sort of parse them to you. This first term up to, like a small correction is approximately the quadratic variation times not exactly the liquidity at that point, but something that's close. Right. So in other words, this is to a first order, really kind of close to lever that we had before. And the second term is exactly the probability of trade. Right. So it's kind of like the arbitrage profits are the kind of the profit stream we had before when it was continuous in loss versus rebalancing. However, it's thinned by the fraction of time that the arbitrageurs can arrive and actually trade. And if you look at, sort of the parameter dependence, again, dropping the constant terms and sending delta t to zero, what you get is that it's basically sigma cubed square root of delta t divided by gamma the phi. Right. So when the fee is greater than zero, what I just showed you is the arb profit scale by this. In particular, we're interested in scaling by the square root of the inner block time. This, of course, was arb profits per unit time. If we look at arb profits per block, well, the block is delta t units of time, so we're going to get a 3/2 power. And so the immediate observation is that arb profits are superlinear in block length. And this has a bunch of corollaries, right? First corollary is that faster blocks mean less LP losses due to arbitrage. So for example, if Ethereum were to go from 12-second block time to 3-second block time, in this model, arbitrage profits would be reduced by 50%. And as I mentioned in the introduction, this is kind of sort of a really kind of a micro-founded quantitative intuition for why we really need faster blockchains. We really want to get rid of arbitrage profits. It's a friction, right? I'm taking money from LPs and reducing the liquidity in these pools, and it's minimizing gains from trade. So to that end, we really want to reduce arbitrage profits. And to my knowledge, this model is sort of the first model which sort of gives that picture. Quite related, it relates to the idea of multi-block MEV. The idea of multi-block MEV is in a blockchain like Ethereum, if a validator can control multiple blocks, they can extract more revenue. They can control multiple consecutive blocks. Why is that? Well, if I control multiple consecutive blocks, what I can do is I can censor arbitrage trades in the intermediate blocks and put in my own arbitrage trade at the end block. And what I'm effectively doing is I'm increasing the block time. If I increase the block time, this formula right here tells me I'm going to make more money for each block. So, sort of the genesis of thinking about multi-block MEV. What is the intuition here? The intuition here is that faster blocks create more competition between ARBs. Right. So in particular, whenever an ARB arrives under my model, because there's competition between ARBs, it's trading until there's no marginal profit. Right. If the ARB was a monopolist, if there was only one ARB, that would not be optimal. In particular, for example, if there is a small profitable ARB possible, the ARB, a monopolist ARB should not trade it, right? Because if they hold off for a little bit, the value of the arbitrage could increase, right? On the other hand, it won't decrease too much because the arbitrage will never be worth less than zero because the ARB won't do it. Right. So this kind of convexity creates an incentive for ARBs to wait if there's a small price discrepancy and only trade on larger price discrepancies. right? Now, if there's competition between arbs, of course they can't do that because if one arb doesn't trade, some other arb will take that money. However, having discrete blocks is a friction which, in essence, prevents these arbs from competing over each other over small price changes, and instead they wait till the end of a block generation interval and they compete over a big price change. Right. So what happens is by making the blocks smaller, we're kind of intensifying the competition between the arbs, and in the limit, they eventually in the presence of fees compete away all the arbitrage profits. Subsequent to us writing this work, actually, Fritz and Canidio wrote a paper where they kind of simulated arbitrage profits versus real prices, like not geometric Brownian motion. And at a 5,000-foot view, sort of they roughly agree with our conclusions. In particular, to quote them, their empirical findings come close to the square root model for most pairs in block times above a second. However, they observe a different regime when the block time is very short. And there they suggest that arbitrage profits appear to decline more slowly than the square root model. And I guess you can see that potentially through the slopes of these lines. Maybe they start out close at a half or a third or something like that, and eventually they flatten out. I think the primary explanation for this is the fact that real prices aren't geometric Brownian motion. But this empirical work suggests that at least maybe above a second, our model is correct. The problem with non-geometric Brownian motion is below a second, you're really likely to have jumps. And when you have jumps, this intuition that over small time intervals you only get very small changes, that's not true anymore because at any instant in time the price could jump. Okay, we are also maybe interested in fees generated by arbitrageurs. So before I computed their profits, net of the fees they pay. Separately here, I'm computing the fees that they pay in the instantaneous rate. Again, I'm not going to parse this formula for you, but what it kind of is lever times 1 minus the probability of trade. And so to sort of summarize the two theorems, the arbs earn lever times the probability of trade. The fees they pay are lever times 1 minus the probability of trade, again, asymptotically and approximately. And so if I add these two up, you see that the arb profits plus the fees the arbs pay to LPs are equal to lever, right? Which was done assuming the arbs don't pay fees and in continuous time, right? So in this case, we have this sort of nice property or interesting property that lever is conserved, right? When we introduce fees, they act as a wedge, and they take some of that lever and they take it away from the arbitrageurs, and instead they give it back to the LPs. I'm running a little short on time, so I'm going to start to wrap up. I'll point out our fees, our techniques can be applied to other fee structures. So, for example, we can think about thinking about fixed costs like gas. Again, just for time reasons, I'm not going to go into sort of detail about this, but maybe the highest level conclusions are that like discrete block time, gas is a friction. It prevents arbitrageurs from trading, and so they wait to trade longer, and the LPs end up losing more money. So lower gas costs result in lower arbitrage profits, the same as faster block times result in lower arbitrage profits. And again, just as lever was conserved, here it's also conserved. However, some of it goes to the ARBs, some of it goes to the LPs, and now some of it goes to the validators in the form of gas. So that's sort of one observation. I'm going to make a quick comparison to sort of Alex's work, which he'll talk about in a little bit more detail. At the highest level, I think our results are pretty similar, and I think it's pretty nice that you have two sort of different models, confirming the same intuition. And again, what I mean by that is if we apply them to a common setting that applies to both, namely a Poisson block times, and if we account for differences in notations and definitions, sort of the asymptotic dependence is pretty similar, like similar square root of t type results. Where are things different? Well, we focus on Poisson block times. Alex's work can handle Gensel block times, so that's 1 point for Alex. On the other hand, in our work, we're really considering general AMMs, and the way we describe AMMs is really micro-founded in how they work. In Alex's work, he's able to make progress in a different direction by assuming that the AMMs are, kind of this stylized, maybe something with constant liquidity. So there's a difference there. In terms of techniques, our primary technique is computing the stationary distribution and mispricing, which I showed you, which involves Laplace transforms. Alex uses this kind of overshoot technique. We're both able to get asymptotic results. We're able, on the other hand, to get also some closed form results, like we can get closed form exact expressions for how much constant product market makers use. And both of the methods can be extended to more complex fee structures. Okay, I'm going to end on one note. The most common question I get when sort of talking about this work is, okay, all this is great. How do we know how to set the optimal fee? Right? Well, let's sort of go back to sort of where we were at the beginning. I argued that the hedged LP P&L is equal to fees minus lever. Again, this is per unit time. What are the fees? Two sources of fees. One is fees paid by ARBs. The other is fees paid by noise traders. How about lever? We argued that lever is also split. It's split. Some of it is ARB profit. Some of it is fees paid by ARBs. And over here, the fees cancel. So what we're left with is the hedged P&L is income from noise traders per unit time minus money lost to arbitrageurs per unit time. So if you want to set the optimal fee, well, from the perspective of the second term, you should set the fee as high as possible. And our model here quantifies that. Right? In fact, if you set the fee to be very, very high, you'll lose no money to arbitrageurs, right? But that's not desirable because also no one else will trade and you'll not make any money from anyone else either. And that's the flip side. So the flip side is to maximize your P&L. You want to set the fees low in order to earn money from noise traders. And herein lies the challenge. In order to set the optimal fee, what I've shown you in this paper is half of it, right? Which is to understand how you lose money to arbitrageurs. You need the other half, which is how price sensitive are noise traders. And that's pretty difficult to model. It's pretty difficult to come up with a micro-founded model for how noise traders behave. So typically people use reduced form models, and it's typically difficult to calibrate them because in data we don't know if someone is an arbitrageur or a noise trader, and so on. So for example, we have some work where we sort of discuss some reduced form models and so on. But this is sort of the practical challenge in terms of applying this model to sort of set fees, is that this model is solving half of the problem. We need to consider the other half of the problem, which is noise traders. And I'll stop there.
Okay, thanks a lot, Ciamac, for the presentation. So I think it's a good time to open the floor for questions, if there are any. So if you have any questions, you can either raise your hand and ask it directly, or if you prefer to write it in the chat, then I can ask it to Ciamac. So while we wait for the audience, I will get us started, okay? So one of the puzzling aspects, I think, when one approaches this topic first, is that there seems to be a difference between the case without fees and the case with the fees, right? So
Yes.
the case without fees, we notice that the lever is fundamentally proportional to the squared volatility, and that it comes out essentially from Ito's formula combined with the minimization that you have done. In the case with the fees, however, you basically have to add two moving parts, as you said. So one is the fee and the other one is the jumps.
Right.
And well, three moving parts technically, because then you also need to have the discrete trading, right? And what we get there, I think, is that the lever is proportional not to the square volatility, but to the cube. Is that correct?
Yeah, that's what I have on this slide.
Right. Okay. So if one wants to kind of reconcile these two results, can you explain how is the best to think about this?
Yeah, so I think it is confusing. It's a great question, and I think in the AMM literature, it's actually caused some confusion. If you look at some of the early papers, I think what's going on is there's like, I don't know if you want to call it a phase transition or a discontinuity or something, but basically there's a fundamental difference between having a fee and not. And you're sort of focusing on the dependence on volatility. Let me answer the question slightly differently. Let me focus on the dependence on block time, right? If you have a positive fee, the block time is going to enter through the probability of trade, and you get this dependence on the square root of block time. Let's say what happens if you have a zero fee, if this gamma is equal to a zero. This term will disappear, and there are no more delta t's left, right? So to first order, there might be corrections. To first order, the amount of money that the arbitrageurs make does not depend on a block time, right? And I think that's just a kind of a fundamental sort of a phase transition or discontinuity. I mentioned it in the slide over here. I don't have a good intuition for it, except what maybe what I said before. What I said before is kind of when you have a fee, even a very small fee, a fee of epsilon. Again, you have to be very close to the boundary to make money. You have to be and as the time interval shrinks, you essentially spend no time on the boundary. On the other hand, even with continuous trading, if there's no fee, at every instant the arbitrager can trade. So that creates kind of this discontinuity or this phase transition, if you will, between having a fee, even if that fee is very, very small, and having a fee which is precisely zero.
I see. So fundamentally, if you have a fee of, let's say, 1 basis point, the result that you get is fundamentally different from what you would get with 0 basis points.
Yeah. So in particular, if you have a fee of 1 basis point, what this would suggest is if you have a very, very fast blockchain, like a continuous time blockchain, arbitrageurs make no money. Right now, versus if you have zero, arbitrageurs make lever. Right now, I wouldn't take the first conclusion very seriously because, again, I'm assuming the price process doesn't have jumps. And we saw in the empirical data that once you're below a second, maybe that's not a good assumption. So I won't take that conclusion literally, but there is a stark change between having a fee of even epsilon versus having no fee.
I see. Okay. Is there anybody in the audience who wants to ask a question? Maxime? Okay, Maxime. So how do I give Maxime the opportunity to speak? Okay, there you are.
Okay, thank you. Thanks so much, Ciamac. Thank you for a wonderful presentation. I've read your papers, so it's always very useful to listen to them. So my question was, if you were to actually try to optimize both time, block time, and fees, does it make sense to try and do that? And what would be the optimal value for both of them at the same time?
So the optimal value of block time is send it to zero. Again, with the caveat I get before, which is that you shouldn't take this model seriously below a second, but set it as small as possible. Now, there's of course downsides outside of this framework of doing that. For example, if you have very, very fast blockchains, perhaps that would encourage centralization and all the validators would be in the same data center and may encourage latency races and so on. But within the scope of the model, you want to set the block time as fast as possible. In terms of the fees, you want to balance, again, the income that you make from noise traders with the adverse selection costs paid to arbitrageurs. So the optimal fee will not be a small fee or a large fee. It'll be some Goldilocks point in the middle, which balances these two. But the optimal block time will be as small as possible.
Thank you.
Okay. Are there any other questions? No, if not, I think maybe we can move to Alex's presentation and then we can have some more discussion towards the end about both papers, perhaps. Alex, are you ready?
Yes, I'm just trying to figure out how to share my slides.
There should be a green button.
Yeah, I see the button. I'm just trying to find the right window to share. So,
all right.
Does this work?
Yours.
My slides, everyone?
Yep.
And I'll do a slideshow like this. Okay. Well, thank you for the invitation. Good morning, everyone. Oh, sorry, it started moving before I knew it. Oh, sorry. Okay, so I'm Alex Nezlobin. I used to be an accounting professor at the London School of Economics. Then I started a crypto company, which is called GuideStar. That affiliation is not longer valid since yesterday, but I'm not yet allowed to tell you what the new affiliation is. So on this slide, I'm just putting my Twitter account for now. Hopefully some announcement will come soon. I'm going to talk today about this paper with Martin Tassi. It's about a question that puzzled me for a long time. At some point, not long ago, I was invited to give a talk somewhere, and this was the slide that I used. I said, this is the state of DEX research right now. What do we know? What do we not know? The first point was that we know quite a bit about arbitrage flow. The second point was that we don't know enough about the uninformed flows. So arbitrageurs are people who trade just to make money against the IMM. Uninformed flows is essentially everyone else. We use the term uninformed in academic finance, but it doesn't mean that these people are silly. It just means that they're trading for reasons other than arbitrage. Maybe they're doing something else that is very smart on chain, but they're just not trading purely for arbitrage reasons. So I thought that we know quite a bit about arbitrage flow, but we don't know enough about uninformed flow. And then, of course, the absolute target that should be for DEX researchers here is how to solve this last question. How do you distinguish between uninformed and arbitrage flows? So I used that slide, but the truth of the matter was that at the time, I thought that we don't know enough about arbitrage flow even, and I still think that that's the case. I still would like to know much, much more. So we know something, but we still don't know enough. Most of the stuff that we know about arbitrage flow came from the papers by Ciamac and co-authors, and then the literature that built on those. So the paper is on lever. Specifically, one result that I had in mind when I wrote this slide was this. By the way, can you see my camera or is the camera off? I'm sorry.
We can see your slides, but we cannot see your face.
Oh, okay. Yeah, I don't know. Should I can show my face actually. I can try to figure out a way to do this quickly. Sorry. Okay, all right. So here I am. So now the presentation is going to be much better going forward. So so one thing that we know from Ciamac's papers is that there is this rate at which arbitrageurs make money relative to so how much money do they make by arbitraging the IMM? And we know that under some assumptions, I'm going to talk about the assumptions in a second, it's a function of three things. The fee that the IMM is charging, so this is the F in this formula. The volatility of the pair, which is sigma, and the block time, which is delta t. So basically you have these three things, and they determine how much money arbitrageurs make. And the money that arbitrageurs make is the money that LPs lose. So we want this number ideally to be smaller. And you can see right away that F is in the denominator. So a higher fee, if an MM charges a higher fee, then of course it loses less to arbitrageurs. So this is one way to solve the problem. But you don't really want to go with a very high F because LPs make money by providing liquidity to uninformed traders. And if the fee is very high, then you are not losing much to arbitrageurs, but at the same time, you're not making any money on that uninformed flow. So that is not a very simple thing to do. Basically, increase the F. It's not free for you to do that. Volatility is outside of your control, essentially. This is the volatility of the pair, how volatile, for example, ETH is relative to a stable coin. This is not something that a protocol can control. This is not something that you can affect easily. So from the perspective of blockchain designers, The thing that is under control is the block time here, square root of t. And so if you look at this formula, you see that the rate of arbitrageurs gain, so how much money they make, increases in block time. So if your block times are slow, then LPs lose more. And this is understandable because LPs do not know anything about the outside world except for the transactions that happened in the past block. So basically, AMMs end up quoting at sale prices. And here I need to qualify this a little bit. I'm talking about AMMs, like very simple AMM designs. They don't rely on any oracles. So basically the traditional Uniswap pools. And so this is a great observation. This is a great result. This is a great formula. Super useful to know that basically if your blockchain is slow, then LPs will be losing more money. The markets are going to be more inefficient. This is sort of intuitive, and this is all good stuff. So now before we jump into the details of this formula, and one detail in particular that I haven't talked about yet is this constant that I have at the beginning. Before we go into the details, let's spend some time on the intuition for it. And I will use my very simple pictures to illustrate the intuition. So this is the AMM. Imagine that the price is somewhere right now. This is the AMM price, PIMM, I called it. All AMMs charge fees. So the fee here is F. And that means that, roughly speaking, the first unit of ETH you can buy from this AMM for PIMM plus F. So this is where the red rectangle starts. And the first unit of ETH that you can sell for PIMM minus F. So the fee essentially creates a bid-ask spread for the AMM. All right. So while AMM is in this position, so the PIMM is where it is, and then you have the spread on each side, the price on centralized exchanges changes. In my picture here, the price on centralized exchanges is P star, and it jumps up and down randomly. If you take some simple model of price moves, like the geometric Brownian motion, or arithmetic Brownian motion would be pretty close to it as well. So if you use something like a Brownian motion for the price move, then the price move between blocks is roughly proportional to sigma times square root of delta t. When do arbitrageurs make money? In a situation like this, when the SEX price is inside the spread, there is nothing that arbitrageur can do. However, at some point, the SEX price will jump outside of the spread, as I have on this picture here. So here the price jumped outside of the spread. And so now arbitrageurs can buy some amount of liquidity on the DEX, the shaded area in this picture, the shaded red area. They can buy it at a price below P star, below the price on centralized exchanges. They can grab this liquidity from the DEX and go and sell it on the SEX at P star. And they will generate a profit by doing that. So now let's think about the total profit of arbitrageurs. Where does it come from? It basically comes from two things. There is the probability of trade. This is the first important component, the probability of trade. How often will they be able to see a situation like this, when the SEX price is outside the spread? So the probability of trade is one component. The second component is how much they make when a trade is available. From Ciamac's paper, and he explained the intuition for this very well, if the overjump is sigma times square root of delta t, then the profit that arbitrageurs will make will, roughly speaking, proportional to sigma squared times delta t. So basically the overjump squared. Let's just focus on the sigma component. The profit that arbitrageurs make is proportional to sigma squared. But again, remember that there are two components of the overall profit. This is the probability of having a transaction plus profit per transaction. Profit per transaction is proportional to sigma squared. What is the probability of trade proportional to? The probability of trade is determined, if you look at this picture, at how often overjumps like this will happen. The length of each jump is proportional to sigma. the spread of the AMM is 2f. So basically, everything is determined by how big the jump is relative to the spread. So sigma over f. And so the probability of trade is proportional to sigma over f. And now if you multiply the two, sigma over f times, remember that the profit per trade is sigma squared, you will get sigma squared over f. And this is what I had in this initial formula. So you have sigma cubed over f. I'm sorry, so sigma squared times sigma over f is sigma cubed over f. So this is where this term is coming from. So this is the formula for the profit of arbitrageurs. And you can sort of get to this formula from these first principles, from the intuition that I just described. But determining this constant is actually turned out to be pretty tricky business. So you sort of know the general functional form of this, but what is this constant? Ciamac's paper shows that this constant is equal to 1/2. So it gives a definite answer. They calculated this constant is equal to 1/2. The calculation is done under certain assumptions. What are the most important assumptions that went into it, from my perspective? I'll mention 3. So the first assumption that you can do, by the way, I don't think that Ciamac's paper actually relies on that. It needs it. It has a more general formula, but at least for this specific special case. The specific special case relies on the assumption that block times are relatively short. So basically, the jump sigma times square root of delta t is relatively small compared to f, as was the case in this picture. So specifically, when I drew this picture, I made sure that the jump sigma times square root of delta t is much smaller than f. So this is the first assumption. This is what we call fast block times. Okay, so fast block times is 1. Second assumption, we assume that there is no fixed transaction cost. So basically, fixed transaction cost is 0. Think about base gas being the fixed transaction cost. We assume that away to make the model tractable. And then the third assumption, and this is a very clever idea that Ciamac and co-authors introduced, for tractability, is that that the block times, or rather blocks, arrive according to the Poisson process. What does it mean that something arrives according to a Poisson process? So you had one block. When is the next block is going to arrive? Basically, if you look at each point in time, the next block arrives with a certain fixed probability. Maybe you have waited for the block for 1 second. Maybe you waited for the block for 5 seconds already. The probability of block arriving at next instant is the same. So this is what Poisson arrival means. Poisson arrival was super descriptive for blockchains like proof of work, like Bitcoin. It may not be super descriptive for blockchains that we have right now, where block times are largely fixed. So for example, on Ethereum right now, the probability of having the next block arriving is much higher if the last block arrived 11.5 seconds from now than if the last block arrived 1 second from now, 1 second ago. This is just how proof of stake works, essentially. So we have to make assumptions to make the model tractable. The first 2 assumptions that I mentioned, that so the important assumption is that the jump is small relative to f. Is it realistic? Well, maybe not exactly, but it's a useful starting point. So at least some blockchains have fast block times, so the result should apply there. We know that. The second assumption that I mentioned, that the cost of gas is 0, probably not as descriptive again, but right now cost of gas seems to be going down significantly. There are L2s where the cost of gas is pretty low, the cost of base gas, I should say. Even on the main net, the cost of base gas is not necessarily super high all the time. So it looks like that assumption we can probably also live with, even though it would be nice to know more about what happened there. The assumption of Poisson block arrival is something that we really wanted to address in this paper. So our first idea when we started was that, well, maybe it's going to be the same constant anyway. Maybe it's 1/2. Maybe the only thing that determines everything is just the average block time. So you consider a model with a Poisson block arrival where the block arrives on average every 5 seconds. And you consider a model where each block arrives exactly 5 seconds after the previous block. Maybe the result is going to be the same anyway. So we started running some simulations. We just ran a ton of simulations. The whole thing is pretty difficult to simulate, to be honest, but we spent some time on it, and it was clear to us that it doesn't look like the result is going to be the same. So for a fixed block time, the result is going to be different than what you get for Poisson block times. So that became pretty clear. What do we do next when we know that the result is different? We try to guess the constant. Pretty difficult to guess. We couldn't guess it right away, so we need something else. All right. Then we remembered that there is this nice decomposition that I just showed to you, that the rate of arbitrage profit is equal to the probability of having an arbitrage transaction times the profit per arbitrage transaction. And so we can compare that decomposition in two worlds, with Poisson block times, with Poisson block arrival, and fixed block times. And we can see which component is actually affected by the block arrival process. And so when we did that, the first thing that we discovered that puzzled us quite a bit is that the probability of having an arbitrage transaction in a certain block is actually the same for Poisson block arrival and for fixed block times. But the loss per transaction, when a transaction is available, the average loss per transaction is lower with deterministic block times. It's better for LPs to have a block arriving every 5 seconds than to have a block arrive according to a Poisson process where blocks on average arrive every 5 seconds. All right, so that was interesting. So then we did some math. Here is the main table from our results. And so in particular, the column that you should be looking at is the LVR lever column, Poisson and uniform block times. And we have a notation that is slightly different from what Ciamac and co-authors used. So ignore the notation, but you see that in the Poisson case, you have something like L times sigma b squared divided by 2. So remember, I told you that the constant was 1/2. For uniform, for fixed block times, you have the same first part. So you also have L sigma squared divided by 2. But then you have the Riemann zeta function calculated at 1/2, its absolute value, divided by the square root of pi. And so this is where this is the exact constant. When I knew that the constant is different from 1/2, I was looking for this expression. What is this constant equal to? And I tried each and everything, and I couldn't figure it out. So
Sorry, Alex,
yes.
in the interest of the audience, can you explain each parameter? What does it mean?
So in this case, it's basically the same thing as before. We just use a slightly different scaling. So L is the ratio of sigma to the square root of, so L is the ratio of sigma to F, essentially, multiplied by delta T. So it's the ratio of let me just go back here. So L is roughly the ratio of the overshoot. You see the overshoot as sigma times square root of delta T here, divided by F. So think of it in Ciamac's notation as basically sigma times square root of delta T divided by F. And then so this is L, and then sigma squared is sigma squared. So this is the volatility of the pair. Basically, this is the remaining part. And then the rest is a constant. So again, I'm sorry that I just copied this table. The notation is different from Ciamac's, from what we had before, but the main difference between our formula and Ciamac's formula is going to be in this coefficient. That basically the additional coefficient is the Riemann zeta function calculated at 1/2 divided by the square root of pi. So if I were to go back to the previous formula here, like this, in Ciamac's paper, this constant is 1/2. In our case, it's 1/2 times the absolute value of the Riemann zeta function divided by square root of pi. And by the way, that constant in our paper is about 0.83, the constant that Ciamac had. So basically you get like 17-20% lower losses to arbitrageurs. This is sort of the punchline. This is the main result of the paper. So let me explain the intuition first. I'm going back to this picture and two things. So first of all, why is the probability the same? The probability of an overjump. Well, if you look at this picture, the overjump happens when you are sufficiently close to the boundary of the spread. So you are sufficiently close, the SEX price, the price on centralized exchanges, is sufficiently close to either the green liquidity or the red liquidity, either the bid or the ask. You have to be very close to that. And then the next step that you take should take you over the bid-ask spread. And the spread is sigma, the overshoot. So what is the overshoot determined by? The overshoot is determined by the interblock times, how much time the SEX price has to deviate from the previous block. And then it's determined by volatility. So basically, since this is, you have to be very close to the boundary of the spread, and the distance from the spread is roughly the same that you can be at. This is why the probability of arbitrage transactions is actually going to be exactly the same in Poisson block times and fixed block times. So the really interesting thing is, why is the loss per arbitrage transaction lower with fixed block times? And to see the intuition for it, we need to break down this event, the overjump event, into two separate events. So think about the price moving continuously, not jumping from one block to the next, but think about the price moving continuously during the interblock times. It's currently very close to the boundary. To overjump the boundary, two things have to happen. So first you need to reach the boundary exactly. And then from that boundary, you still have some time left before the next block to do the overjump. So let's think about the fixed block time situation. With fixed block times, you have, the price has, let's say the fixed block time is 5 seconds. The price has 5 seconds to deviate, to overshoot. It will take some time to get to the boundary. Maybe it's going to be 2 seconds, maybe it's going to be 3 seconds, but it's going to be, usually you will reach the boundary sometime between the two blocks. So let's say that you're reaching the boundary 2 seconds after the previous block. With fixed block times, what time do you have after that to overshoot? Well, if you had 5 seconds total, you are 2 seconds in, you have 3 seconds for the overshoot. So the expected time that you have to overshoot, conditional on being at the boundary, is going to be significantly less than 5 seconds. How about Poisson times? Again, think about this price making some random movements, and then at some point, maybe 2 seconds after the previous block, it hits the boundary. Now we are at the boundary. How much time do we have to overshoot with Poisson block arrival? Well, remember that Poisson block arrival, that's a memoryless process. So it doesn't matter how long you have waited already. The next block, on average, is still going to arrive full 5 seconds later. So that means that with Poisson block arrival, you still have 5 seconds for overshoot. Whereas with fixed block times, you always have less than 5 seconds. So this is why these overshots are always smaller. And basically the formula that we have gives the exact answer to this. And we are doing some additional analysis in this paper. I'm going to save you the details on this, but I will just give one more result, which I think is pretty big from this, is that the probability of an arbitrage transaction is the same. Loss per transaction is lower. And it turns out that of all the random processes of block arrival that you could consider, with the same average block time, it's better to have deterministic block arrival. It's best to have deterministic block arrival. So deterministic block arrival is the best regime for LPs on chain. How do we know that our results are correct? So on this one, first, we're doing two things. First, we're using some fancy math that Martin discovered. Specifically, we're using something known as ladder height calculations, and ladder height result in stochastic processes. So again, I was looking for that constant for a long time. I was at the end of the rope. Martin came around it and turned out that he found this paper on ladder heights, and that basically solved everything for us. What is this analysis? I'm not going to go into much detail, but generally how it looks, how do these problems work, ladder height problems. You consider a random walk. You can consider actually a discrete time random walk, which is very nice for our purposes. And you basically have two boundaries. You have a lower boundary and a higher boundary. And you consider the process that starts at the lower boundary. So for example, lower boundary can be 0, the upper boundary can be 1. And the process is going to be fluctuating between these two boundaries. So you start at 0, and then you start beating this ladder. Maybe you went up a little bit, maybe you went up, then you went down, and so on and so forth. So the question is that if you end up below your lower boundary at some point, let's stop the clock there. The first time we ended up below the lower boundary. What is the amount by which, on average, we will be lower than 0? And this is, if you see what I'm talking about here, this is precisely the question that essentially we need for lever. So much of the result turned out that it actually existed somewhere. You just have to look in the right literature. So fortunately, we found this literature in stochastic processes that helped us a lot. So the second thing that we do, and I will just show you again the basic result, is that we're doing a lot of simulations in this paper. We're doing a lot of simulations because even if you have a nice result here, you still have to convince yourself that everything works. And here we are looking at how precise our formulas are for different values of this parameter that we call rho b here. So again, I'm not going to go into details, but basically rho b shows how big the fee is relative to the step. And so our results are only valid in a fast block regime still. So you have to say that blocks are sufficiently fast. When rho b is high, this means that blocks are super fast indeed. So you see when this parameter gets greater than 1, the percentage error, so when we say 0.6, it means that our formula gives a 65 basis point error. This is what you have at 1. But as you increase this parameter further, you go to higher values, it basically converges almost all the way to 0. So it's below 1 basis point when the parameter is at about 3. And we're specifically looking at 3 components separately: the probability of trade, which is delta P trade, the probability of the loss per trade, so there's delta LVR, and delta ARP is the product of the two. And so you see that on both components, our results converge, which again gives us hope that the results are correct. So this is again the state of DEX research as I see it right now. I know that a lot of other exciting work is being done, and so hopefully we will hear soon about it. On arbitrage flow in particular, I think this area we know the best. And then there is a lot of stuff that we don't know about uninformed flow. I was going to talk about it, but for the interest of time, I will not go there. I'll just finish with my favorite Tolstoy quote, because I really want to attract everyone's attention to this problem of uninformed flow as well, is that all informed traders are alike. Each uninformed trader is uninformed in their own way. So personally, lately, I started to develop much more interest in learning something about uninformed flow, because in traditional finance, we don't know much about uninformed flow from my perspective. We know a lot about arbitrage trading. We know much less about uninformed flow. In DeFi, we certainly know, for now, even less. And so I feel like this is going to be a super interesting area to study. This is all I have to share. I'm happy to answer any questions you might have.
Okay, thanks a lot, Alex, and for ending with this Anna Karenina's quote. I thought it was the opposite, quite frankly, that all uninformed were noise traders in the same way, and the informed each had a different bit of information, but looks like it's the other way around.
Well, I think that they have all different information. I agree with you. So their information is different, it's more precise, but their behavior is in many ways similar. They know the true price, the arbitrage to it.
Yeah, I
If you
mean, in
think
the
about the
context
behavior of uninformed
elements.
traders,
Yeah.
there are all types of uninformed traders. They're doing very different things on chain, it looks like.
Okay, does anybody want to ask a question? If you want to ask a question, raise your hand or use the Q&A feature. So while we're there, I'm going to get it started. So first question is, so in your, according to your intuition, fundamentally, wouldn't a drift in the price, which I think you're assuming is zero, right, affect the probability of informed trading?
Right. So I would have to think, this is a great question. This is a great question. I would have to think about it. My quick improvised answer on this is that it depends on which component you are talking about. Because if you think about, so let me just go back to my slides for a second. I don't know if you can see them. Can you still see my slides, or did they stop sharing?
We still see Anna Karenina.
All right. Okay. So let me just see if I can go back. Okay. So here you have it, right? So there are two components. There is the probability of trade and there is overshoot. So now imagine that you have a drift. Which component would drift affect? The probability of trade or the overshoot? I can tell you for sure, almost for sure, that the drift is not going to affect how much profit arbitrageurs make relative to when the transaction is available. Why is that the case? So take a look at the size of the step. It is equal to sigma times square root of delta t. So let's remember this. The size of the overshoot is sigma times square root of delta t. What is the drift proportional to? Because drift will also contribute to this step. Drift in a normal model would be proportional to the drift parameter mu times delta t itself, not the square root, but dt. For small values of the step, square root of delta t is a much higher number than delta t itself. So one thing I know for sure is that if you had some drift in the process, drift would not affect the profit per arbitrage transaction. But the drift might affect the number of arbitrage transactions. So that I cannot say right away. It may or it may not. I don't have a strong prior on this. It will certainly affect the distribution of arbitrage transactions on one side and the other. So basically on the bid and then ask. Because if the price continuously drifting towards bid, you will have more arbitrage transactions at the bid.
But at the more technical level, perhaps there's also the issue that, if I remember correctly, in your model, you're assuming that after every trade, the price is basically reset to the midpoint of the bid-ask spread, correct?
So we're assuming that the price, the bid-ask spread is reset so that the sex price is actually at the boundary. So if you look at this picture, yeah, so if you look at this picture, you see the sex price is just past the boundary. Arbitrageurs will take all the liquidity that is shaded and take that away. So after that, the side, basically the boundary of the bid-ask spread will be exactly at the sex price. So that I believe still holds even with the drift. Yes, they will still do the same thing essentially.
So fundamentally, what you're saying is that the intuition is that the drift should be a second order effect.
It certainly should be second order effect for profit per arbitrage transaction. I'm less I'm less sure about the number of arbitrage transactions. I'm inclined to say that it's probably second order as well, but I wouldn't know without doing
All right. So does anybody in the audience want to ask a question at this point? No? So I don't know how much time we have left. I would kind of ask Fahad to guide us there.
We're actually over time, but
we're actually over time.
But it's a soft constraint.
Okay, so I will just try to ask a question that perhaps can be of broader interest without going too much into the technicalities, right? So I remember having a chat once with Ciamac and or maybe you said it in publicly, I don't remember exactly. But basically, this arbitrage trading seems to be a very significant part of the overall trading in the DEX exchanges, right? So what I was wondering is whether it is possible to use also some measure of, let's say, the trading volume on these exchanges to get some extra insights as to what the effective parameters in these DEXs are or should be, or whether the distribution of the block times has an effect. I mean, it's a open-ended question fundamentally. So can we use volume data to learn more about lever and arbitrage trading more generally?
Yeah, so so good. So not me, but many others, including Alex. I don't know if he's published anything of it, but he certainly I've seen work he's done. Have tried to look at the quantity of arbitrage trading. It's a little bit challenging because arbitrageurs don't necessarily announce themselves, or and also people have multiple motivations for trade. So maybe part of the motivation for trade is arbitrage, but part of it is something else. But I think numbers I've kind of seen are that something like 60 to 70% of DEX volume is arbitrage volume. Of course, it also maybe depends on the DEX. From the perspective of informing the model, I think that the key thing to try and understand is, and I 100% agree with Alex, and we actually didn't coordinate, so it's kind of interesting that we both have the same point, is to understand the non-arbitrage trade. Because I think, again, we can sort of quibble about details, but to a large extent, arbitrageurs will trade as long as they can, make money. But the non-arbitrage trade is sort of hard to quantify. And I think in particular, the main parameter to figure out how to set is the fee. And so you're looking for not only to understand the non-arbitrage trade, but how is it sensitive to fees? And we don't necessarily have natural experiments where we change the fee and see do people trade more or less or whatever. I think maybe the closest kind of thing it would be to try and think about maybe think about gas as like an artificial fee, and or as an instrument maybe. And so do arbitrage traders noise traders trade more when there's the gas is higher, not allow that for variation. But I think the key kind of practical question, which I haven't seen good analysis of, is how sensitive are these uninformed noise traders to fees. I think if we had that, we would have the ingredients to kind of figure out how to optimally set fees.
Okay.
Yeah.
Alex, do you have something to
Yeah,
add
I
here?
just want to say real quick that, I think that this is, so I definitely agree with everything Ciamac has said, and I think that it's super useful to understand the uninformed flow in practice. I have not done a super systematic analysis of things, but let me just point out that, first of all, some things you can see pretty easily. Arbitrage bots don't really hide that much. There are 3 or 4 top arbitrage bots on each chain in each main pool. You can see what they're doing. They're doing the same thing from the same contract, essentially, most of the time. And so you can analyze their behavior. You can see how much money arbitrageurs are making. To see if the formulas hold up or not, or to calibrate the formulas, to link it to theoretical results, it would be nice to have some natural experiments where things happen, and then you see how the losses to arbitrageurs are affected. We've had some areas where you could compare the results. So, for example, one thing that I did very quickly, I looked at, there was very crude research again, but I looked at how much money a certain pool loses on base, where block times were 2 seconds, versus how much the same pool essentially is losing on Arbitrum, where it was largely first come, first serve, up to the recent times when they switched a little bit to a different system. So you can see that 2-second block times cost LPs money. There is no question about it. One area that I'm excited about is that there are changes happening all the time right now. So, for example, one thing that would be interesting to look at recently is what happened on base. Recently, because base switched from 2-second block times to flash blocks, which are essentially every 200 to 250 milliseconds, I don't remember. So now they reduce block times quite significantly. And so you have a very nice natural setting where you could compare what the losses were to what the losses are right now, and maybe get some insight on whether these formulas hold up there. So there are some areas where you can do this empirically. I personally do not view these formulas necessarily as providing like super sharp mathematical answer to what you should expect, but at least you know that you are thinking in the right direction. So they give you like a good directional prediction. Not long ago, before some of these papers came out, people were seriously arguing whether short block times are good or bad for arbitrageurs. And there was a significant number of people saying that, hey, maybe the longer block times are actually better for LPs and worse for arbitrageurs. So there were people saying that. It wasn't obvious. Even like the basic direction wasn't obvious back then. There were great arguments on both sides. And so I think that now this question is sort of largely settled. And it doesn't really matter that much if the formula is super precise or not, but at least it gave us the directional result.
Okay, I see that Daniel Finan has a question. Go ahead.
You there? Can you hear me there?
We do.
Oh, sorry. Okay, great. Yeah. So this talk about arbitrage profits and also block time, it kind of sparks the thought in my mind that at the moment DEXs kind of rely on the arbitrage process in order to keep prices fresh, in order to have non-stale prices. You reduce that block time closer towards zero, and there's less and less arbitrage profit, but at the same time, arbitrage is still kind of needed. So I suppose my kind of roundabout question is, you're kind of then looking towards the point at which the price discovery then takes place on the DEX rather than on the SEX, because that's the point at which the arbitrage is kind of not really necessary. Does that make sense? I'm not sure if I really phrased that the best way, but
yeah, it makes perfect sense. So it makes perfect sense. I actually had a slide. I didn't go there, but if you still can see my slides, I can, so first of all, we know from Ciamac's paper that when block times are going all the way to zero, you almost don't lose anything to arbitrageurs. So you are right that price discovery could, in theory, more of it could start happening on SX. I just want to say that this is one of the biggest things that is happening right now is where does price discovery come from? And so basically right now, many of the approaches that we use, I mean, everything for passive LPs, price discovery is coming from the arbitrage flow. And of course, that still has high running cost, but that high running cost is going down as DEXs become faster and faster. So maybe eventually, the problem will not be there. The nice thing about it is that there is a bounded worst case on what can happen if you just rely on arbitrage flow for. So if you're thinking about the traditional Uniswap math, so for traditional Uniswap math provides you some guarantees that if you place liquidity in this particular shape, and then if price comes back to a certain point, you know what your loss is going to be. There is a different approach, in particular with proper MMs right now, where they bring Oracle observations on chain. And this can result in significantly better ongoing performance. So you essentially bring an Oracle observation, you position all your liquidity around that, and you move it freely as you report the new price. So this can work great. The problem, though, is that sometimes if your Oracle is manipulated, for example, if something terrible happens to your Oracle, then you can have a spectacular failure where you position liquidity around something else and you can have an unbounded loss. So those kinds of AMMs, they're not necessarily, one wouldn't necessarily want to do an AMM like that for passive LPs. But you're exactly right that there is this problem that you're relying on arbitrage flow to discover prices. The potential solution to it is to make block times much shorter, and then possibly price discovery will be happening on chain. Because sometimes there is not even a comparable off-chain venue with the same liquidity.
Okay, great. So there are no more questions. I think since we are already very much over time, this is a good place to end. So thanks everybody for attending this session, and we look forward to seeing you again at the next CBR seminar.